Thank you. We've got Mr. Gunjan Shah, who's the CEO, now joining in. Thanks for being with us on ET Now. Let's begin with the numbers because it's been a robust Q4 for you, higher than expected margin expansion, largely on the back of the price hikes and the improved product mix that the company has been taken. Do you believe that with volume growth that has been a little bit under pressure, we are likely to see those metrics continue, that margins will continue to hold out while volumes may look a bit soft?
Yeah, hi. Nice to be here, and thanks for inviting me. Yes, we've managed to proactively manage those margins largely through three levers. One was to make sure that our product mix significantly improves. Our movement towards casualization and sneakerization has obviously aided that effort. The second piece that has helped us is basically, tightening our belts and bringing in cost efficiencies at many parts of our operations. So that's giving us decent dividends. And the last piece that has helped us manage inflation is, as you said, price hikes. So I think all these three levers will continue, right? We will have to closely watch how inflation goes going forward, but that's how I see right now the situation.
Okay, fair enough. That's the view coming in on the overall performance metrics. But getting a move on, given the fact that we're seeing these unlocking trends really play out, schools have finally reopened, what kind of demand uptick have you seen in the fashion footwear and formal footwear specifically as categories?
Right. So there are certain short-term bounce backs that are happening, which is a normalization of consumer behavior somewhat after the distortion of the last 2 years. And the other piece is longer term trends. So I think the piece of normalization is we are obviously seeing now with the occasions going up in terms of people going back to offices, schools, as well as even other fashion and marriage occasions. That's pushing the big time in terms of response and bounce back of fashion and formal footwear. The longer term trend, however, is the one that I just mentioned a little time back, which is casualization and sneakerization. Consumers are wanting to take the comfort that they have been used to for the last 2 years working from home to their various occasions where they go out. And that is something that we are trying to make sure that we have our portfolio in line with these trends, and is also backed by the latest campaign that we have launched, which is 24/7 casual collection, along with our brand ambassador, Disha Patani.
I'm just going to clear the air for the benefit of our viewers. It's a question which keeps on getting asked when you see a promoter exiting ownership. Can you confirm, can you just tell us that that's nothing to do with business operations and the commitment towards India? It is something which has happened in the promoter domain, the block deal yesterday?
Absolutely. So it's nothing whatsoever. It doesn't impact the majority control that the promoter has, and it is just a simple small minor stake dilution, which was in line with certain restructuring in the family trust. No impact whatsoever on Bata India.
See these block deals, the first assumption is, why is the promoter reducing stake? So thank you for that clarification. Let's understand your revenue target of 5,000 crore by FY25. How would you achieve that? Is this largely a organic growth target which you're setting out?
No, so it's an ambition, right? And yes, we do know a few levers that we will want to press upon, right? Which will aid us in the journey towards that kind of an ambition and goal. There will be a few more levers that we will excavate as we go forward. We do know certain white spaces that we want to get into. So let me talk about the levers that we know and we are working upon, right? The ones that I think one is the piece that I've somewhat hinted in the conversation till now, which is making sure that our portfolio moves in line with the categories that are going much faster. And I think this entire piece on sneakerization, we have seen some great response to the effort that has gone in the last 6 to 8 months. And the sneakers portfolio of ours, which is about 20% contribution, has grown at almost at 30% points faster than the overall category growth of ours. The second big piece that we will also see gain traction going forward is basically in terms of our footprint expansion. The brand equity of Bata is extremely high. It is, and among so many brands that I've seen, I think it's one of the stratospheric levels in terms of awareness and consideration. And it does justify a much wider footprint than the current footprint that we have of about, 1,600 odd stores of exclusive outlets. So there were two things that we are trying to do on that. One is that aggressively expand our franchise stores and take us into smaller cohorts of consumers, etc. And whether that's deeper penetration into tier 3 to tier 5 towns, and also leverage obviously the aspirations of middle India and rural India that's quickly ramping up. The second piece also on footprint expansion is basically in terms of multi-brand outlets. We right now, our distribution vertical caters to almost 25,000 outlets. The universe there is much larger. We go to about 1,000 towns, and we have ramped both of them up. But I think there's still a huge amount of headroom for expansion there. So both of these will significantly aid, obviously, expansion, availability of Bata products, and therefore revenue growth. The third piece that's also going to fire and is doing reasonably well, I think, I would say over the last 3 years, is the entire digital footprint. Our e-commerce business is now into double digits contribution, despite normalcy and retail offline taking off back again. And we see this growing faster. Last quarter, it grew faster. Last year, it grew faster. And I don't see a reason why it should not be significantly accretive to our growth. So these are a few of the levers that will aid this entire journey. In addition to this, we will obviously keep looking for inorganic opportunities in terms of white spaces where we feel there can be complementarity in terms of brands.
Your margins, which were, let's say, just below 20, I'm looking at, and I'm keeping the COVID aberrations aside, right? I'm looking at the normal trajectory. It's now north of 24. Is this a cost-cutting benefit? Is this your premiumization strategy which is working for us? I'm bundling a lot of questions here. And the third question is this the new normal, 20% plus now?
Okay, so we don't give forward-looking forecast, Nikunj, but however, I think the piece that I would like to highlight is that we are not way off from our, I would say, pre-COVID normals. So it is not, it is definitely not something that is, an aberration per se. It is just reverting back to normalcy. Obviously, it's aided by a few efficiencies that we have gained. One is during the COVID period. The second is some more that we have basically tried to activate upon during this period that is aiding this. We would like to ideally make sure that these margins are not, how do you say, an aberration and remain stable.
This is Nantar also joining in on the conversation. So I was reading a brokerage report by Axis Securities, and what I found very interesting there is, and they're saying your strategy will also be now, given inflation, to increase your market share, particularly in the smaller towns and cities where you're going to become quite aggressive and take share from the disorganized market as well. Is that correct? Is that what you will be doing?
Yeah, and that's what I hinted towards when I talked about the footprint expansion. A large part of that footprint expansion will be in tier 3 to tier 5. Last 2 quarters, just to tell you, we would have added about, so last year we added the largest amount of franchise stores, exclusive Bata stores under franchise model in the history of our company. And I don't see the space slackening. Maybe it will only accelerate going forward. So we've added almost 20 to 30 stores every quarter for the last 2 quarters. And I'm assuming that this pace will continue, if not accelerate.
I also understand that given a cost checking exercise, you of course have a healthy balance sheet, is to introduce Flexi work hours in your stores. And I don't know if our viewers know about it as much, or even Nikunj and Avan, Bata already has 25 all women stores. Is that also going to be, are you going to accelerate on that?
No, absolutely. I think diversity and inclusion is a big agenda for us. I think it really makes the organization and company far more agile, far more receptive to ideas. And this is one small initiative towards that. We want to see how, so we've now got to 25 all women stores. We want to get them going even more, right? And obviously aid the performance of the company also. The piece on Flexi is slightly different. It is basically to do with the fact that our footfalls and consumer traction in our stores through the week and through the day is very different. And therefore, we want to make sure that we are, how do you say, having that versatility and agility in our manning structures so that we are able to cater to these spikes in demand that happen through the week and therefore cater to it.
So have more manpower in stores when you expect more footfalls seems to be the strategy. Bata very much in focus this week. You had the earnings report card a few days before that, but then the promoter selling 2.8% stake. First time Bata on a new media house, only on ET now, making an important clarification for how it is part of an external restructuring exercise as well.